All right, welcome back to another episode of the Black Bullion Show. So, guys, guys, and small percentage of ladies, silver is going to blow its top. Well, at least that's according to one analyst who makes a pretty interesting case. His name is Ted Butler, and we'll get into his analysis shortly. But first, if you're new to this channel, please hit that big red subscribe button right down below. Also, please hit the like button. Helps to get this economic evangelism right on out there to the masses to bring more people into precious metals. Now, this article comes from SilverSeek entitled The Silver Pressure Cooker. Now, in the start of this article, Butler compares the silver price with the gold price. He talks about how year to date, the silver price is relatively unchanged, which is pretty shocking. And, this is also pretty surprising given that gold's increase in performance has been roughly around 19% this year. I believe even in the last quarter two of 2020, it performed about 12%, a 12% increase, which is pretty wild. But let's get into Ted Butler's analysis here in this brief highlight. And I quote, as for why silver's price relief valve has ceased to function and gold's valve is somewhat sticky, uh, that's obvious. The release mechanism was gummed up due to concentrated short selling on the COMEX. For years, the concentrated short selling was led by JP Morgan, but the bank has recently abandoned the short side, leaving 8 other big shorts to deal with a mess when the lid blows off. So, what are the heat sources causing the pressure to build in the silver market? For the past few months, the main heat source has been the massively insane quantities of physical silver purchased by and deposited into the world's silver ETFs, led by the largest, SLV. More physical silver, 220 million plus ounces, has been deposited into these investment vehicles over the past few months than at any time in history. Let me repeat that. Never in history has so much physical silver been bought and deposited into silver's investment vehicles in such a short time. Common sense would dictate that much more physical silver being bought in less time would exert much greater pressure or upside price pressure. To be sure, silver prices are up from the March lows, but are flat from year end and still down 65% from the peaks of 9 years ago. This is not complicated math or advanced pricing formulae. More of a commodity being bought in the shortest time ever should result in a sharp price advance, most likely the sharpest in history. Absent such an expected advance, explanations for why this hasn't occurred should be apparent. But that's the problem. Namely, no good or at least legitimate explanations come to mind. Clearly, the price of silver, the release valve on the pressure cooker, is not functioning. Stated differently, this is yet another clear proof that the price of silver is manipulated. Now, guys, manipulation is a problem. And I don't want to get into that for the purposes of this video, but his point on the amount of physical silver that has been bought within such a short period of time to satisfy the volume of inflows into silver ETFs shouldn't go unnoticed. And let's take a look at SLV actually. So we have SLV right here, and obviously this is one of the largest ETF funds that Butler mentioned in his article. Let's go down and take a look at the volume within SLV since its start. SLV began on April 28th, 2006. So that's how far back this historical data goes. It goes back to that quarter. Now, each one of these black bars here represents quarterly data for SLV. So we're going to look at the quarterly volume data for SLV. So take a look at the quarters during the financial crisis. For the most part, SLV was in the low to mid teens with volume hovering around low to mid 100 millions or so, as you can see right here. We're in the 100 millions. We got 700 million, we got 500 million, 700 million, 500 million, 600 million, 300 million, 200 million. This is kind of like what you kind of got used to a little bit. And around quarter three of 2010, let's get there. So quarter three of 2010, SLV saw the price rise to $21.31. In the last quarter, it was $18.21 with higher volume. But in quarter three, SLV saw the price rise to $21.31 with a dip in volume in the mid 100 millions or 500 millions. Then things shot up quickly in the next quarter. With quarter four of 2010, SLV got to $30.18. Volume finally hit in the billion territory. We had 1.7 billion in volume for SLV. Then obviously things shot up from there and then eventually hit a peak and then came down. Now let's go up to more recent times. Let's go to quarter one of 2020 when we were at $13.05. And guess what the volume was? The volume was 1.5 billion, yet we were only at $13.05. Now, granted, this was during a time when we had the major hit to silver. But then we had a little bit of a rebound and we came out of that. Quarter two, we went up to $17, but we were at 1.6 billion. Now, take a look at, just as a quick reminder, we were at 1.7 billion in quarter three of 2010 at $30. Why are we nowhere near that right now? It just goes to show what Ted Butler was saying. We have all of these inflows coming into SLV right now, yet the price isn't reflecting that. Why isn't the price shooting up? We should be definitely within that $20 to $30 range given the large inflows. So I'm going to ask you guys, why aren't we seeing that price increase right now? Let me know in the comment section below what your ideas are. Thanks again for watching. Please hit the like button. Please subscribe. It's Black Bullion.